So are you wondering what happened to that big tax and spending bill that was making its way through Congress? It seems like it's been making its way through Congress since the beginning of 2021. Well, things are getting close, and we're going to talk about that in just a minute. My name is Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our Financial Perspectives, where we take a look at the last few weeks at how markets have behaved and what things are going on economically and maybe a little bit politically, and try to determine if there's anything investors should know and things they might want to be doing as a result. First, let's take a look at markets since Thanksgiving. You can see they've been a little bit flat, a little bit rough really since Thanksgiving, although the U.S. stock market is represented by the green line there, the S&P 500. It did close at a record high on Friday. So things have been kind of holding together pretty well over a 2021, which has been a good year for stock market investors for the most part. Again, you'll see that green line. The U.S. stock market is represented by the S&P 500. So those large companies are up over 25% for the year. Small companies up over 12% for the year, though they had been much higher than that just a few weeks ago. But it's been a good year for small company investors as well. The purple line represents developed market economies, stocks in those countries. And then the pink line represents emerging markets, economies or companies in those emerging markets, countries, and they've not done quite as well this year. It's one of the few areas of weakness in the overall global stock market. In terms of employment in the United States, well, things have been good. The help wanted signs are still out in force. I'll tell you what, though, new unemployment claims dropped to a 52-year low last week in November. That 52 years ago was September of 1969. So we haven't seen new claims for unemployment benefits this low since the late 1960s. Really, the biggest issue in the labor market is just there are more jobs available than there are people looking for work to fill them. Pre-pandemic, 83% of the population between 23 and 54 was either working or looking for work. Post-pandemic, that number's dropped to 82%. So the labor force participation rate has declined, which means less people in the job market overall, which makes it just that much harder for employers who are looking for qualified people to fill those jobs that they have available. Some of that is feeding into inflation. There's a lot of things feeding into inflation. There's a lot of cash in the economy right now. People are making purchases again as they kind of come out of their pandemic hibernation. Inflation has been showing pretty big numbers. The November over November, or the last 1 year inflation number, rose to 6.8%, as reported last week. Auto prices were up in that same period 11%. That's a record. Also, your Big Macs and Chick-fil-A and sub sandwiches are probably costing a little bit more because fast food prices rose 7.9%. That's also a record. In response to this inflation, the Federal Reserve has talked about kind of tightening on some of the things that they do. So they may begin to taper their bond purchases sooner. They've already announced a desire to do that. They also are considering raising interest rates maybe sooner than people thought. Both of those things would serve to slow down the economy. It's hard to think that we're talking about slowing down the economy as we're just coming out of that pandemic economic crisis. Another thing that people are talking about in regards to inflation is the Build Back Better bill, that tax and spending bill that's working its way through Congress. There's some concern that if they pass a bill with that much spending, that it would just increase the inflationary pressure in the economy. The Build Back Better bill is really in the red zone right now. If you're a football fan, you know what this means. It's when your team has the ball, they've moved the ball inside of the opponent's 20-yard line, and they're there trying to score. When the House passed the bill in November, it kind of moved this bill into the red zone. The Senate could vote to pass the bill, at which point it would go on to the president for signature. The Senate may also amend the bill. If they amend it significantly, it would have to go back to the House for them to pass it again before it ultimately gets to President Biden's desk. The interesting thing about the Build Back Better bill, as it exists right now, in some ways, is the way that it's changed from how it was originally talked about back in early 2021. In terms of tax policy, there was some concern early 2021 that there was going to be a lot of onerous taxes in the bill. As it turns out, a lot of those taxes didn't make the final form of the bill, or at least the form that was passed by the House in November. So what's out that people thought might be in? Well, there was certainly thought of increasing the top marginal rate from 37% to 39.6%. There was talk of long-term capital gains rates moving from where they are now to as high as 25%, or maybe even becoming as high as ordinary income tax rates. Neither of those things made the House bill. There was talk of eliminating the step-up in basis of death. There was talk of reducing the estate tax exemption. There was talk of increasing the corporate income tax. All of these things did not make the bill passed by the House and currently in the Senate. So what did make the bill? Well, a 15% corporate minimum income tax made the bill. That means for large corporations that are profitable, they would be subject to a minimum tax rate on those profits. Also, a 3.8% net investment income tax of 3.8% was put in the bill, and this applies to pass-through entities. These first two items probably produce the most potential new revenue to the government of any part of the bill. And one of the reasons for that is in that 3.8% net investment income tax, this represents a whole group of people, small business owners, who may have very profitable businesses. In the past, those business profits passed through to the underlying owners without having to pay a Medicare tax on it because they were passed as profits as opposed to wages. Well, this bill would look at those distribution of profits and tax them a little bit more like wages, and that would apply that 3.8% net investment income tax to them. For very, very high wage earners, there are some increases in taxes. If you make over $10 million a year, you would be hit with a 5% surtax on amount over $10 million. If you make over $25 million, surtax would grow to 8%. One of the more interesting things, I would say, something that most people should maybe pay attention to is a limitation on Roth conversions, the potential to limit the amount of money that could be converted to Roths from traditional IRAs, as well as who might be eligible to convert. So in 2022, the bill right now would say taxpayers making over $400,000 would be ineligible to convert their traditional IRA dollars to Roth IRA dollars. That means if you're thinking about Roth conversions, you may want to really think more carefully about them in 2021. Also, the SALT deduction in the House bill was raised from $10,000 to $80,000. Now, that would result in actually a tax decrease for many Americans because it's an increase in a deduction. However, just today, the Senate draft of the bill was released, and they've struck the SALT tax deduction increase from the House bill. That's an amendment. We'll see what actually survives. So a lot of moving parts. The question is what investors should do as a result of this. Well, for sure, you should examine Roth conversion opportunities in 2021. If this is something you've considered doing or been doing up to this date, you'll want to take a careful look at it this year because of changes or limitations that may come into play in 2022. If you're making charitable gifts, of course, you want to do those before the end of the tax year. Those are deductible in the year that you make the gift, especially if you're making gifts above the standard deduction amount. As always, you want to construct portfolios with a comprehensive and long-term planning view. You don't want to try to get too predictive in regards to the future because we know it pays to embrace uncertainty because there is an inevitability to change. And we've certainly seen that as this tax bill has gone through different conversations and amendments to get to the place where it is right now. I think probably the most important thing investors should do right now is they should concentrate on enjoying the holidays. Do the things that you love to do with your family and friends and enjoy this holiday period. And while in that period, try not to pay attention to who's throwing the most coal in Washington, D.C. Thanks for attending our Financial Perspectives this week. This is going to be our last one of these for 2021. It's been a pleasure to do these things throughout the year. We'll be back in 2022. And if you have some questions you'd like to see us address in 2022, please let us know at the contact information on your screen. Also, if you'd like to meet with a Foster Group advisor, take a look at how things have gone for you financially or investment-wise, or you want to do some planning for the future, we'd love to have that conversation. You can reach us at any of those, again, kind of points of contact on your screen, set up an appointment, and we can get together in person or via the web, whatever works for you. At a schedule, I think we can find a time that would just be great. So again, thanks for joining us for these. We hope you have a very happy holiday season, and we'll see you in 2022.